I want to relate to an interview with Stanley Druckemiller. The link is in the show notes, and kind of use it as an inspiration. Stanley is one of the few old school macro investors that are still around that kind of paved my way into this business. The purpose of the Not Even Wrong podcast is to give people a sense for what it feels like to run a hedge fund. And I think this is a good time maybe to reflect back and give a little bit of a story for what drove me to actually get into this business and how I evolved and where we stand today. The purpose of this episode is not just to give a history of where we came from and how Stanley Druckemiller and that scene of people that he was involved in about 30 years ago influenced my decisions to get into the business. So that's part of it. But the main reason is also a conclusion of where we stand today and how we see this going on. We see, to jumpstart the conclusion, we see today a very rare combination of forces that are all driving into a direction that certainly will create lots and lots of wealth. And whether we are right or wrong in terms of what we're actually investing in, of course, that's a different question. And please don't take this as investment advice. Do your own work. The purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. We sometimes talk about our views, and we sometimes talk even about our positions, but this is not meant to solicit any investors. Please don't contact us through this channel. This is just simply an educational podcast. So what we see is three massive forces, very big macro forces, and that's why I use Stanley as an inspiration, because he's a macro investor and he does very similar work like we do. He starts from the bottom up and then connects it with the macro. So the big ones are, number one, we have technology on our side. We have particularly AI and also space travel, space exploration. Those are the two big trends that we see. Related to that, we could also throw in energy, but we don't want to throw in energy per se because we don't see massive innovations in energy per se, but it's adjacent. So whether we want to become an interplanetary species or whether we want AI to solve three-dimensional, basically physics, we're going to need a lot of energy for that, and that needs to come from somewhere. So there's an investment case to be made, but we're not talking about the innovation in energy. We're talking about an adjacent factor of demand. The innovation is happening in space and it's happening in AI. So that's number one. Number two, we have DOGE, the Department of Government and Efficiency, which is tied to the fact that Donald Trump is going to be president of the United States. So we're undoing a massive waste of government money, and the same way that wasteful money has spillovers into the economy through corruption and inflation, the same way a reduction of waste also has a sort of a, if you will, a negative spillover or a positive effect on the economy in terms of freeing the economy of corruption and inflation. And third, I think this is the biggest and a little bit uncertain also, it's that for the first time, I think, at least since the foundation of the Federal Reserve, I think the U.S. establishment is questioning the value of the dollar and the value of having a reserve currency as part of the United States economy. And the reason that this is being questioned is that I think we went too far. We have too much deficit. We have a soft budget constraint. We have way too much debt. So the fiat system of the United States is in serious question. And that, of course, in itself opens up many questions in terms of a macro investor. For example, if Donald Trump should choose to buy Bitcoin as a reserve currency, then of course Bitcoin will appreciate dramatically relative to the dollar. But that's the first trade. There's many different side effects of this. I think fundamentally, when everything is said and done, having a strong currency with a rule-based strong currency with limited supply will have enormous amounts of positive effects on the innovation and the innovation forces of the U.S. economy. However, it also will cause lots of social strife. So it's not so clear how this will pan out, and it's possible that we could end up in a fascist, communist, ideological nightmare also, because when there's too many people on the sidelines that don't participate in the value creation of the economy, we could also see negative effects. So I don't think that this third factor is only positive. But for us now, as a trading theme, it is positive. Maybe long term, we might have to rethink this. This is not even on podcast. It's December 26, 2024. This is Grimdelco. For the year, we're up roughly 111%. The market's up 27%. We're outperforming by 84%. The market is still open. These numbers could change. So, like I said, let's start with Stanley Druckemiller and why he's an inspiration for us. And then talk a little bit about some of his big trades, some of the drawbacks of his strategy, and then finally return to today and discuss the big macro forces that we think will drive wealth creation in the coming years. Stanley Druckemiller belongs to a rare breed of hedge fund managers that understand equities and also understand macro and connect those two. He's also one of the few managers that is able to make money in different asset classes, whether it's currency, bonds, equities. But he's a bottom-up macro investor, so he starts with equity. He understands the business from the businesses themselves, and then goes and understands the rest and tries to trade around that. I think the biggest takeaway from this interview that is linked in the show notes is that when it comes to investing, the most important thing actually is sizing and not necessarily investing. So what that means is that, look, you can have a lot of ideas and you can have a lot of, let's say, triggers, meaning, oh, you want to do this, you want to do that. But what really matters as an investor is that you have a few really, really good ideas and then you put lots of size on them. And I think we at Orange Capital Partners, it took us quite a while to go through this process ourselves, to learn this. And I think we are at that point now where we have very, very high conviction in a certain amount of stocks or situations for that matter. And we're going to talk about our conviction towards the end of this episode. And if you want to go back, I mean, this podcast has been going on for 4 years, I think, at this point. So there's a lot of history already in terms of what we were thinking and how we were positioning ourselves. So there's a little bit of a track record I think we can show that this is not just us talking hot air, that we really put our mouth where our money is. So back to Druckemiller. I think, again, it is not necessarily so important to be right many times. What matters is to have a large position when you're right and to make sure you don't get killed when you're wrong. That's what investing is all about. And this is, it's a subtle point for some. I think for us in the business, it's not subtle at all. Anybody who's had actually trading positions, you do have issues. And I want to mention the word leverage here because we all have leverage. Some people have more than less, but the thing with leverage is you are always exposed to market forces that could force you to sell positions, whether that is because you actually have leverage against your stocks and margin positions, or whether that is also, let's say, your cost structure, your fee structure, your customers pull money. Like you always are exposed to some sort of leverage. And that's, I think, the most important factor a hedge fund manager has to take into account. Because on the way up, everybody's cheering. On the way down, people want out. And on the way down, you also have to, you still have to pay your rent. You still have to pay your salaries. You have to pay your own living expenses. And you might be forced to sell at the worst time. So that is a very, very tricky situation. Now, of course, there's one way to deal with that, which is you can have a buffer, right? You can say, well, I'm just never going to be in that situation. Well, in order to never be in that situation, you need to understand how bad can it get. And those are very, very difficult questions to answer. For us at Orange Capital Partners, we've actually had our nightmare scenario a few years ago when we had the peak of the fund and the trough of the fund were about 9 months apart. And we were down 72% from the peak. So that is a drawdown that most fund managers cannot survive. We actually did survive. And this is also, in my opinion, the biggest, let's say, the biggest question mark I have with Stanley Druckemiller. He shows a little bit of vanity and lack of humility when he says, I was never down. I always only had up years and so on and so forth. Well, really, in terms of dollars, you probably were down. And here's what I mean. Look, you can, let's say, be down 70, you can have $1 billion, lose 72%, that is $720 million. So you're down to $280 million. You close your fund, and then you start another fund, let's say with $200 million, and then you double, triple that money, quadruple that money, you're up to $800 million. So in percent, you're back up, you're actually up for the year, but in terms of dollars, you're not up for the year. So, and that's because you blew up. That's because you had to liquidate your funds at the worst time, and then you can restart somewhere else and all that. But it's just very, very difficult to keep making money in dollar terms. And I think Druckemiller should be a little bit more honest about what he means with never having had a down year. Is that in percent or is that in dollars? And my guess is that in dollars he's actually had down years. It's only in percent that maybe he has never had down years, but that really doesn't matter. Percentages are just accounting mimics for fund managers. They don't make a difference. What matters is dollars. So, but nevertheless, I think he's still a very important inspirational figure, and I will count him as one of my inspirational factors. I've had the pleasure to work with people that have worked with him. I've never actually met him myself, but I think there's definitely some wisdom there. There's some market wisdom, some skill, and all of that. And we would be not well advised if we didn't learn from people like him. So let's talk a little bit about, let's say, a few of his trades. The famous one is the British pound trade. Now that trade is interesting because there was a peg between the Deutsche Mark and the British pound. And what he did is he went against that peg. So that was a cheap trade in a sense that Chinesing that trade, or if you will, going against that peg was costing him only, I think, 0.5% a year. And he made, I think, 20-30% of that trade. So because he was able to put a massive amount of leverage, he actually made a lot of money with that trade. So trades like that are really amazing trades, and I think the whole so-called special situations risk off community came out of that trade, because what people were thinking is that they don't want to have any kind of market exposure, beta. They don't want to be exposed to the market's ups and downs. They just want to have a very sure downside and lots of upside, and this is one of those trades. And I think, again, there was a whole generation of people who were inspired by this trade in the 90s and the 2000s, and I kind of grew into that type of hedge fund community myself. That's where I met my partner Zoe. Now she was doing that. I myself was an options trader doing options trading, and I combined options trading with risk arb and used it as a tool in particularly in biotech, where it wasn't exactly like that. There wasn't a very clear downside and lots of upside. Actually, in biotech, it's extremely volatile, but there was still lots and lots of money left on the table in terms of things like FDA decisions and things along those lines. The volatility was mispriced, so that's why I was able to make money my first couple of years on Wall Street, and that money actually seeded me to start Orange Capital Partners, and here we are today. So I think again, this is just an important lesson. I think I don't necessarily want to now make too much of a big deal out of this particular trade. I think the British pound trade was a great trade and good for them and everything. I think another interesting trade that he mentioned, and this is more du jour right now, is the Nvidia trade, right? And I want to actually use this to segment into where we stand today. So what Druckemiller is talking about is the Nvidia trade. He says all these young kids from MIT and Stanford, they went to AI, they stopped doing whatever they were doing, algo, crypto, that kind of thing, and started doing AI. And that's true. That is still the case. And I think I feel very close to this type of thinking, because that's what I do. I mean, that's really what we do on a daily basis. We live in Palo Alto, and we actually spend a lot of time at Stanford attending seminars, conferences, all those things, trying to understand where the science is going, because the way we see ourselves is equity investors that try to find the Venn diagram between science, technology, and entrepreneurship. And we also like to make dollars. So that means that we're not in the startup business where we make, let's say, turn $100 million into $500 million, which is great, and nothing wrong with that. But what we like to do is we like to turn 100 billion into 2 trillion. Like that's, $1.9 trillion of value creation. To us, it's worth more than $500 million value creation. And although in percent it could be similar, but in terms of dollars, that's what matters. So we like to play there where value creation in dollars is very high. That typically happens in the Venn diagram when we have technology, where we have science, technology, and entrepreneurship combining into opportunity. And that's what's happening in AI right now, and that's what's also happening in space travel. And space travel, by the way, is a little bit more broad than just, let's say, what SpaceX is doing. It just means that we have a new innovation in flight technology, whether it's in orbit, out of orbit, to Mars, or there's a lot of innovation in that space, which will open up doors for new types of travel technology, and also, of course, new types of, for example, telecom technology, like Starlink. So now you might say, okay, look, what does that actually mean? What does that actually mean when we talk about this convergence of science, technology, and entrepreneurship? Well, what it means is that, and I want to use P to Thiel's P times Q, which is like when you have a massive wealth creation, that's usually combined with you create lots of value for society, and then you also can capture some of that for yourself. This is how wealth is created. So to be clear, that's not always obvious. Take a flight technology, for example, airlines and all that. They have never made money for the shareholders. But for society, you could argue it's valuable. Nuclear power is similar. And there's a couple of examples like that. Now, we don't want to be in those. We want to be in the types of companies and sectors where there is lots and lots of value creation for society, and then also a tremendous amount of value creation or capture for the company. AI is such a place because it's human intelligence, and what it really means is what AI does, it helps iteration, and iteration is the fundamental force of disruption and economic growth, because the faster you can iterate, the faster you can error correct, the faster you can come up with new things and solve problems, whether it's energy, whether it's society problems, whether it's developing a new heat shield for Starship. More iteration is better, and AI is on the path of helping us with that. Right now, we're only in the text realm, but we're going to get, and this is the big bet that we have at Orange Capital Partners, which is we think that the next stage is actually the real world in physics, and we need training for that, and then we have applications for that. The training is provided by NVIDIA, and the application provided by Tesla. Those are the two biggest examples where we think massive value creation will happen. So this is the first big force that we see actually going forward in the next couple of years, wealth creation. The second biggest force is DOGE, and I want to be very clear what I mean with that. With DOGE, I don't just mean the Department of Government Efficiency, which is run by Vivek Ramaswamy and Elon Musk, but the whole general purpose sort of attitude of the Trump administration to put common sense back into the White House, to stop wasting money, and to put their regulation where it's supposed to be, which is to help society and not to be some sort of regulatory capture for monopolists, or even worse, some sort of activist arm for activist left-wing type politicians. Regulation is meant to be there to help us do business, to help us grow businesses in a more sustainable way. And most of the time, regulation actually is not even necessary. Self-regulation or regulation by liability is much more effective than the kind of regulation that we have seen mushroom under the Biden administration. So getting rid of regulation, the bad type of regulation, to be clear, and also stopping to waste money in the government, those forces will unleash massive amounts of energies in the economy, and I think we are actually witnessing this. We had a rally in the market, and we believe that this will continue. Now, the third is actually the biggest factor, which is a factor that's not well understood yet by us, and I think most of the market, and that is that we are really transitioning away from the U.S. dollar. We're transitioning away from the U.S. dollar in a sense that the U.S. establishment actually is starting to question the validity of the U.S. dollar, and that's because I think we just went too far. We went too far in many ways, and that's part of the reason why we have DOGE. We have way too high deficits. We have way too much debt. We're spending way too much money on interest rates. All of these things, it's just not sustainable anymore, and therefore there is a legitimate question whether we should have something like Bitcoin as a reserve currency. And this is the first time since the Fed, I think, is founded, as far as I can remember, that that is being questioned. In fact, we went off the gold standard under Nixon. We have a fiat system right now where the whole world, including the United States, believes in the United States dollar as the reserve currency, and that is now being questioned by serious investors and serious institutional players, and not just Michael Saylor, of course, but many, many other people that I respect, people that I think have much more of a say and much more of a view in the economy than just, let's say Bitcoin traders and people along those lines. So this is definitely an interesting trend, and I would say that this has to be taken seriously. I would also add to that the fact that for the first time, the United States has seen a situation where the Fed is cutting interest rates and the long-term rates have been rising. And that is something one has to think about a little bit more deeper, because this really is unprecedented. And when the bond market makes moves like that, we need to look into it. Now, there's a couple of interpretations for that. My first interpretation is actually this is good news, because we have a steepening of the yield curve, and steepening of the yield curve is a good sign because we expect economic growth. Now, some people might say, yeah, that's true, but it also sort of puts a corset on the economy, right? So what we could see, hopefully, is that we have an absolute lower level of interest rates, but still a steeper interest rate curve. That we don't see that right now, but this would be a good scenario. The more scary scenario is actually the one where the markets are losing faith in the Fed and in the ability for the Fed to organize the interest rate market, and the markets are taking over and saying, look, it's us, we are deciding, not you. And that, of course, is opening up a Pandora's box, because now if the markets take over, we are not really sure that this could also go wrong, right? We could see sell-offs in the U.S. Treasury market, lost in faith in the U.S. dollar, and then I don't think this would necessarily be a good thing for U.S. markets. Now, for U.S. stocks, particularly for the kinds of stocks that we own, like Tesla and Nvidia, in the long run, it shouldn't make a difference, because again, we are investing in long-term technology trends, the Venn diagram, remember, between science, technology, and entrepreneurship, and that's not necessarily tied to any kind of currency. So you could just basically have a devaluation of the dollar relative to, let's say, gold and Bitcoin, but you have a massive appreciation of stocks in dollars. And then maybe in terms of Bitcoin or gold, it might not do as well, but that's not our main concern right now. Now, what I want to say is, though, I think overall the opportunity with this shift away from blind belief in the US dollar as a reserve currency towards something like Bitcoin, I think that's good news, because number one, it has already inspired DOGE, and I think it's going to bring much, much more discipline into the US political system. Once you have a constraint like this, even Congress with its ridiculous lack of term limits and corruption, all of these things will be discussed. They are being discussed right now on X. They will be discussed more seriously, maybe even in the Supreme Court going forward. So there's lots and lots of reasons to be positive at the fact that we will have less corruption in the United States, and that again will have a massive spillover effect onto the economy. So overall, we're incredibly positive about the U.S. economy. Now, what does that actually mean for trading? Now, we have very large positions in Nvidia and Tesla for the reasons we just discussed. There's some other ideas that we're floating around. One is that the US dollar will strengthen relative to all the other currencies. In the meantime, depreciate against the Bitcoin. So that is one trade that we should be thinking about a little more seriously. And in the sort of realm of, or in the spirit of Stan Druckemiller, this would be like, once you have an idea which has a good merit base, you could play many different ways, and this is one way you can play this by shorting, let's say, emerging market currencies. There's a question of the yen and the euro, which are sort of pegged to the dollar, not pegged like in a formal peg, but there's certain understandings that the euro should be around 110, something like that. We think it can go to 50 cents. The yen should be between 100 and 150. We think it should go to 1,000 because of just that situation and the lack of growth in the Japanese economy. So there's a lot of these types of trades that are interesting. We spoke about this already in our meetings. We haven't put on anything, but those are interesting trades. And it's sometimes also, you might not put on the trade, but it's still valuable to think about it just as an exercise. So to summarize, the way we see 2025 and the coming maybe 2 to 3 years to evolve is really driven by those three forces: DOGE, technology, and a shift away from blind belief in the U.S. reserve currency. We think that people like Stanley Druckemiller have inspired us to think about these things. So kudos to him. We linked this in the show notes. We think that making high returns in the end comes down to having a very concentrated bet with lots and lots of money invested in good ideas and then sticking with them. And of course, at the same time, making sure that one can sustain drawdowns. And I think the last thing I want to mention here, just going into next year, is that we're incredibly proud and happy that we've been able to recover and now put our customers also above their watermark again, because we had this massive drawdown 3 years ago. And I think this lesson learned from the last 2-3 years is that high conviction around technology, science, and entrepreneurship is ultimately the best value creation that an investor can look for.